So welcome to today's Talk Ticker's deep dive into Charles Schwab's Q2 2026 earnings call. That's ticker symbol SCHW, by the way.
Right. A really fascinating one to dig into today.
Oh, absolutely. And for the listener, our objective here is simple. In under 5 minutes, we're going to extract the headline numbers, translate all that dense Wall Street jargon into plain English, and give you an actionable, opinionated take on whether Schwab deserves a place in your portfolio.
Because if you monitor the financial sector long enough, you kind of develop a distinct ear for how these corporate earnings calls usually go.
Yeah, exactly. You expect a very specific, heavily lawyered tone.
Right. Like it's an exercise in managed expectations.
Yeah.
The executives come on, they highlight macroeconomic headwinds, emphasize how conservative they're being.
And they deliberately set the bar just low enough that they can comfortably clear it next quarter. We see it all the time.
All the time. But when we look at this Q2 2026 print from Charles Schwab, that entire defensive playbook is just noticeably absent.
It really is. I mean, we are looking at a quarter that completely shatters the conventional growth algorithm for a, mature financial behemoth.
Yeah, the vibe was just totally different. I mean, the departure from the standard corporate script, it was evident before they even broke down the info statement.
Oh, totally. Right out of the gate.
Right. So Jeff Edwards, who heads up investor relations, he framed the opening remarks by comparing their second quarter performance to the Spanish national soccer team securing a major championship.
Wait, really? The soccer team?
Yeah, La Roja. He explicitly labeled the quarter's results as, quote, trophy-worthy.
Wow. That's bold.
It is. I mean, in the context of a highly regulated, historically conservative brokerage firm, deploying that level of unhedged confidence, it signals that management isn't just pleased with a temporary beat.
Right. They think they've actually crossed some sort of structural inflection point in their business model.
Exactly.
But, that level of rhetorical swagger, it forces you to immediately interrogate the data. Like, does the underlying math actually justify the tone?
Right. You got to check the receipts.
Exactly. So let's start at the top of the funnel with the headline numbers. Total revenue for the quarter hit $7.1 billion.
Which is massive in absolute terms.
It is. But the critical metric here is the velocity, right? That is a 21% year-over-year top-line growth.
Yeah, 21%.
I mean, for a nimble mid-cap software firm, 21% is a solid quarter. But for a foundational pillar of the American financial system managing trillions in assets, accelerating revenue by more than a fifth in a 12-month period is insane.
It suggests a massive reallocation of market share, honestly, or a fundamental expansion of their monetization engine.
Right.
Actually, it implies both. A legacy institution of this scale, they can't achieve 21% top-line expansion just by tweaking fee structures, or running a successful marketing campaign.
Yeah, you need more than that.
Exactly. Growth at this magnitude requires multiple uncorrelated business units to hit simultaneous operational peaks. But the revenue figure is really only the setup.
Right, because the truly disruptive metric is the profitability, right? The operating leverage they generated from that revenue.
Oh, yeah. Adjusted earnings per share came in at a record $1.62.
Which is just an explosive 42% jump from the prior year.
Yeah, 42%.
I mean, that 42% figure is the anomaly that we really need to unpack for you. Because again, it's like a mature, slow-moving blue chip stock is suddenly putting up the kind of growth numbers you'd expect from a scrappy late stage tech startup.
It's totally counterintuitive.
Exactly. And the mechanism bridging that 21% revenue growth to the 42% earnings explosion is their pre-tax profit margin. It hit an astonishing 54.3%.
Which is wild.
Right. For anyone modeling financial sector margins, keeping 54 cents of every gross dollar before taxes is almost physically impossible, given the massive overhead required to run, branch networks, compliance grids, customer service centers.
Yeah, the physics of a 54% margin in this sector is entirely dependent on the compounding math of technological scale.
Break that down for us.
Sure. So over the past decade, Schwab has invested billions into their proprietary routing technology, automated clearing systems, cybersecurity infrastructure.
Right. Huge upfront costs.
Exactly. Those are immense front-loaded fixed costs. But once that digital chassis is fully built and integrated, and especially after they finally absorbed the TD Ameritrade architecture.
Oh, right. That was a huge merger.
Yeah. So following that, the marginal cost of executing the next 1,000 trades or onboarding the next 1,000 accounts, it just dropped drops precipitously towards zero.
Okay, so it's all about scale.
Precisely. And CEO Rick Worcester actually confirmed this dynamic on the call. He noted their expense on client assets is currently the lowest in the entire industry.
Wow.
Yeah, so that isn't just an efficiency metric, it's a structural moat that allows them to absorb massive volume spikes without needing to hire a ton of people or increase processing overhead.
Which leads directly into the asset gathering, the raw volume they are absorbing right now. Over the first half of 2026 alone, they brought in 2.7 million new brokerage accounts.
That's a staggering number.
It is, and that drove $260 billion in core net new assets. That's up nearly 20% year over year. I mean, gathering $260 billion in 6 months is effectively swallowing a mid-sized asset manager whole.
It really is. But the context around these numbers is what makes the whole Q2 narrative so compelling.
Right. Didn't they just have an investor day?
Yes. Just weeks prior to this release, back in May, management hosted their investor day and outlined their internal forecasting models for Wall Street.
Yeah.
And these current Q2 numbers didn't just beat Wall Street's expectations, they completely blew past management's own internal scenarios laid out just a couple of months prior.
I mean, that internal forecasting miss might be the most revealing data point of the entire quarter.
Oh, absolutely.
Because, when the internal data science and financial modeling teams at a firm like Schwab teams that have access to real-time client flow data across tens of millions of accounts, when they fail to accurately predict their own near-term momentum, it means something is shifting.
Right. It indicates that historical correlations are breaking down. The behavioral patterns of their client base suddenly shifted into a higher gear that their predictive models just hadn't historically mapped out.
Okay, so let's get into the story behind the numbers. How exactly does an established financial giant generate a 42% spike in earnings? What broke their internal models?
Well, based on the transcript, it comes down to two major engines running red hot.
Okay, what are they?
The transactional trading engine and the balance sheet lending engine. They're highly synergistic, but let's look at the trading side first because the absolute volume there is just staggering.
Yeah, daily average trades DA hit an astonishing 12 million. Executing 12 million trades every single day drove trading revenue up 28% year over year to $1.2 billion.
Yeah, and to contextualize 12 million daily trades, you have to realize that Schwab is essentially routing a third of all retail trading volume in the United States right now.
A third. That's incredible.
It is. But management was very deliberate in explaining that this volume isn't just some random fluctuation. They attribute it to a structural shift driven by 4 converging factors.
Okay, let's hit them. What's the first one?
The first is a distinct demographic shift. The median age of active market participants is dropping.
Right, younger investors.
Exactly. We are seeing a younger cohort engaging with the markets with far more frequency than previous generations did at the same stage of wealth accumulation.
And I'd argue the demographic shift is inextricably linked to their second structural driver, which is the permanent shift away from trade commissions.
Oh, 100%.
Because when the industry transitioned to zero commission trading, it didn't just remove a friction cost. It fundamentally altered position sizing and trading psychology.
Yep, completely changed the game.
Like, if a younger investor is deploying a $2,000 portfolio, a $10 commission represents a massive, immediate drag on performance. By removing that drag, you unlock an entirely new frequency of engagement for smaller accounts, which aggregates into millions of daily executions.
Exactly. The zero commission environment lowered the barrier to entry. But the third driver management highlighted, and this is huge, is the mainstreaming of options trading.
Oh, yeah. Options have blown up.
Right, because historically, options were viewed as complex, institutional-grade instruments. Today, retail investors are routinely utilizing options contracts to generate yield through covered calls or to hedge specific portfolio risks.
And how does that impact Schwab's bottom line?
Well, because options trading inherently involves higher turnover and carries different execution economics than standard equity trades, this retail comfort with derivatives serves as a massive revenue multiplier for the firm.
Makes sense. And then the fourth driver they mentioned is the technological accelerant, right? Artificial intelligence.
Yes. Management pointed to a surge in AI-driven algorithmic trading and research among their retail base.
And to be clear for the listener, we aren't just talking about users asking a chatbot for stock picks, right?
No, not at all. We are looking at retail clients utilizing sophisticated APIs and AI screening tools to build actual programmatic trading models that execute based on specific statistical parameters.
Right. When you hand institutional-grade AI tools to a retail base that pays zero commissions, you naturally see an explosion in daily average trades.
It creates a continuous feedback loop of engagement. The AI tools allow retail investors to process macroeconomic data, earnings transcripts, and price action at unprecedented speeds.
They just feel more confident.
Exactly. Because they feel more informed and can identify setups faster, their confidence in executing trades increases, which effectively raises the baseline floor for daily volume across the platform.
Okay, I understand the theoretical framework of those four drivers: demographics, zero commissions, options, and AI. But I really have to play devil's advocate here and stress test this narrative.
Sure, go for it.
Because June 2026 was not a normal month in the financial markets. It was completely dominated by the highly anticipated SpaceX IPO.
It really was. You couldn't escape it.
It's exactly. The media hype and retail frenzy surrounding that specific equity debut was inescapable. So I have to ask, is 12 million trades a day just a temporary sugar high driven by hype around things like the SpaceX IPO? Or is this a true structural shift in how retail investors behave? Are they conflating a one-off liquidity event with sustainable change?
It's a great question, and actually that exact skepticism was voiced during the Q&A session by Devin Ryan. He's an analyst who specifically pressed management on the, quote, multiplier effect of the SpaceX IPO on their June metrics.
And what did they say? Because if it's all SpaceX, we expect a severe drop-off in Q3.
Right. But CEO Rick Worcester's response drew a very critical distinction between transactional noise and permanent asset gathering.
How do you clarify that? Because, any broker can claim the volume is sustainable until the volume disappears.
Well, Worcester openly acknowledged that the SpaceX IPO drove intense, anomalous volume into their customer service centers. It required immense bandwidth from their financial consultants. The engagement was unquestionably elevated.
Okay, so he admitted the spike.
He did, but he explicitly clarified that this specific event did not artificially inflate their net new assets, or NNA.
Ah, interesting.
Yeah, while competing platforms might have seen a surge of hot money flowing into newly opened accounts solely to flip the IPO, Schwab's asset growth remained broad-based. It was diversified across their existing and newly onboarded client base.
So the assets are sticky.
Exactly. Management explicitly stated the trading floor is elevated because of a structural shift in engagement. The 12 million trades represent the new baseline of how these clients interact with their capital on a daily basis, regardless of single stock mania.
That is a crucial operational distinction. If the assets are sticky and the engagement is systemic, then the trading engine is structurally sound.
Right.
But, as impressive as $1.2 billion in trading revenue is, the real margin expansion story lies in the second engine, the lending book.
Oh, absolutely. This is the commercial banking apparatus housed inside the brokerage.
Right. And in Q2, their total bank loan balances ballooned to $67 billion. That is a 33% increase.
The acceleration of that loan book is really the primary catalyst for their profitability metrics. And the core product driving that 33% expansion is the pledged asset line, or PLL.
Which saw massive growth, right?
Yeah. Management noted that PL usage surged by a remarkable 59% year over year.
Okay, let's pause here. For the listener, let's translate what a pledged asset line actually is and why it's generating 59% growth. Basically, these are loans for the wealthy, right?
In essence, yes.
Because if a high net worth client holds, say, a highly appreciated $10 million stock portfolio, and they need $2 million in cash to buy a house or pay for college, selling $2 million's worth of stock immediately triggers massive capital gains taxes.
Right. Nobody wants to pay that if they don't have to.
Exactly. Plus, it removes those assets from the compounding engine of the market. So instead, with a PLL, you just use your stock portfolio as collateral for a cash loan.
Precisely. The client pledges the $10 million portfolio as collateral for a $2 million revolving credit line. The equity remains invested, deferring all those capital gains taxes, while the client gets immediate access to cash at a competitive interest rate.
It's brilliant.
It is. And from Schwab's perspective, this is the ultimate high-yield, low-risk asset. Because if the equity markets face a severe drawdown, Schwab possesses the immediate authority to issue a margin call and liquidate the underlying stock to make the bank whole.
So the credit risk is basically zero.
Functionally neutralized by the collateral, yes, but the yield they generate on the loan is significantly higher than alternative safe haven investments.
And this 59% surge in PL usage, it really speaks to a broader behavioral trend among affluent households, right?
Yeah.
Something the expert management team categorized as the bull market for convenience.
Yeah, I love that phrase. It perfectly captures what's happening. Schwab noted a really compelling statistic on this. 22% of households with investable assets between $1 million and $5 million now utilize only one financial institution for their entire balance sheet.
Just one firm for everything.
Right. And what is truly staggering is that this figure jumped 11 percentage points in just 12 months.
That 11-point leap is a violent acceleration in financial consolidation. I mean, affluent clients are just actively rejecting the friction of managing a fragmented financial life.
Yeah, nobody wants a mortgage at a legacy bank, a checking account somewhere else, a trading account on an app, and a wealth manager at an independent firm.
It's exhausting. They just want one unified dashboard where they can park their cash, take out loans, and trade all in one place. And because Schwab spent the last decade building out this exact holistic infrastructure, they're capturing the lion's share of this consolidation wave.
And that consolidation feeds directly into their net interest margin, or NI, which is another crucial metric we have to look at.
Let's explain how that works. When clients consolidate their assets at Schwab, they bring significant cash deposits with them.
Right.
And the spread between what Schwab pays the client on those deposits and the yield Schwab generates by deploying that cash, that's the net interest margin.
Exactly. Historically, if Schwab paid 1% on deposits and parked that cash in 4% U.S. Treasuries, they captured a 3% spread. It's safe, it's steady. But the influx of pledged asset lines fundamentally rewires that spread math.
Because they make a much higher spread on these loans.
Exactly. It creates a massive yield enhancement. When Schwab redeploys those same deposits into a pledged asset line charging the client, say, 6 or 7%, the spread violently expands.
Right.
CFO Mike Verdeschi detailed that lending products like PLs generate an average spread in excess of 100 basis points higher than their standard securities portfolio.
Wow. So as the bull market for convenience drives clients to park cash at Schwab, and those same clients increasingly utilize PLs, Schwab's net interest margin expands rapidly without taking on any corresponding duration or credit risk.
It's a beautifully synchronized business model. The trading engine drives immense asset gathering, and then the lending engine monetizes the balance sheet at structurally higher margins.
The two engines just feed each other. But, as an investor, you buy the future, not the past.
Oh.
Q2 was a blowout. But what is management signaling for the rest of 2026? Are they projecting a continuation of this compounding cycle, or are there macro headwinds?
Well, the forward guidance provided on this call was extraordinarily aggressive in its optimism. They significantly upgraded both their revenue and margin outlooks for the full year.
Give us the numbers.
Full-year revenue growth is now projected at a robust 17.5% to 18.5%.
That is incredibly difficult to sustain across a $7 billion quarterly revenue base.
It is, yet they're projecting exactly that. Furthermore, they are guiding for that all-important net interest margin to expand to between 3.0% and 3.0% for the full year, and exiting Q4 even higher at 3.25 to 3.30%.
Applying a 3.3% NIM against hundreds of billions of dollars in interest-earning assets, that translates into a tidal wave of operating income.
A literal tidal wave, yeah.
But hold on, let me interrupt here, because as I parse the guidance metrics, one specific projection jumped out as a potential red flag. Management is expecting full-year expenses to grow 9.5% to 10.5%.
All right, let's call it 10%.
10% expense growth sounds high. In an industry where technology is supposed to drive down costs, projecting a 10% structural increase in operating expenses seems counterintuitive. Is that a red flag for the listener? Is the infrastructure straining under those 12 million daily trades?
It's a completely fair question, and it's a necessary stress test of their narrative. But CFO Mike Verdeschi addressed it by breaking down the mechanics of their operating leverage.
Break down the math for us.
Sure. A 10% nominal increase in expenses is only problematic if it outpaces top-line growth. Let's look at the components of that expense increase. A portion of it is directly tied to variable processing costs generated by those record trading volumes.
Which is a good problem to have.
Right. You also have to factor in their recent acquisition of Forge, which expands their footprint in the private market space. Absorbing Forge added roughly 100 basis points to their total expense growth.
Okay, so it's volume-driven costs and strategic M&A, not administrative bloat.
Exactly, and the math of operating leverage is what actually neutralizes any concern here. Even with expenses growing at 10%, remember, revenue is growing at 18%.
Oh, right.
That 8 percentage point delta creates 800 basis points of positive operating leverage, meaning profits are growing far faster than costs. Verdesi actually noted that at the beginning of 2026, their internal models assumed they'd generate only 400 basis points of operating leverage.
So they've effectively doubled their margin expansion velocity.
Exactly. When revenue outpaces expenses by 800 basis points, the absolute dollar amount of profit scales exponentially.
Okay, that definitely reassures me on the expense side. It proves the infrastructure is working as designed. However, management isn't modeling for infinite unabated growth, right? In their guidance, they specifically lowered their assumption for daily average trades down to 10.6 million for the full year.
Right, a significant drop from the 12 million we just saw in Q2.
Why lower it?
Well, it reflects conservative forecasting rather than a breakdown in those structural drivers we discussed. Management is accounting for the typical summer slowdown.
Oh, right. People go on vacation.
Yeah. Trading volumes historically compress during the late summer months as institutional and retail participants literally just step away from their terminals. By lowering the day assumption to 10.6 million, they establish a highly achievable baseline.
Which means if the structural engagement stays high, they could easily beat Q3 estimates again.
Exactly.
Yeah.
It's smart under-promising.
Let's talk about interest rates, because that was the most provocative macro assumption in their guidance. Every financial institution is beholden to the Federal Reserve, and Schwab is currently pricing in a single 125 basis point rate hike late in the year, in December.
Which is a stunning assumption. A standard Fed rate adjustment is 25 basis points.
Right. A 125 basis point hike in a single meeting is practically predicting a tectonic shock to the global monetary system.
It really is. It suggests the Fed is anticipating a violent resurgence in structural inflation. But from a purely operational standpoint for Schwab, they noted that because this hike is modeled for December, it basically has zero negative impact on their 2026 bottom line.
Because the year ends before it hits.
Yeah.
But it sets up 2027 for even further margin expansion.
Exactly. If that hike materializes, the yield on their floating rate pledged asset lines instantly jumps. Verdesi explicitly stated their net interest margin would see even more expansion moving into 2027. They're weaponized to profit from a rate shock.
The structural durability is just incredible. Okay, so we have the data, we have the drivers, and we have the outlook. Let's boil this down to an actionable takeaway for you, the retail investor.
Yeah.
What is the bottom line verdict here?
The verdict is decidedly bullish. For years, the market treated Charles Schwab like a discount broker. If that were still true, they'd be in a race to the bottom against every new gamified app.
Right.
But this quarter proves they are successfully proving they are no longer just a discount broker. They are a one-stop shop financial behemoth.
And their strategy of converting self-directed traders into wealth advisory and banking clients is working flawlessly. Management revealed that when a self-directed retail client transitions into the Schwab Wealth Advisory tier, they generate 3 times the return on client assets.
Without spending a single dollar on external customer acquisition. That conversion dynamic is driving incredibly durable mid-teens earnings growth.
So the actionable takeaway: if you hold the stock, this earnings call is a massive validation of the long-term thesis. Hold tight and sleep well at night.
Totally agree.
And if you are considering buying, Schwab represents a highly profitable play on 2 major demographic trends: the consolidation of affluent wealth into single platforms, and the gamification and AI acceleration of retail trading.
It's a highly defensible, high-margin position.
All right, before we wrap up, I want to leave the listener with a fascinating strategic nugget to mull over. A final provocative thought. At the very end of the Q&A, an analyst asked about prediction markets.
This was such an interesting moment.
It really was, because prediction markets have seen an absolute explosion recently, heavily driven by Gen Z money. Competitors are leaning heavily into these gamified markets to attract younger demographics, letting them bet on, like, pop culture or sports.
Right. These platforms allow users to execute binary options based on real-world events.
But Schwab's CEO, Rick Wurster, completely shot it down. He explicitly stated they will not offer sports or pop culture prediction markets. He called it disingenuous to label them as an asset class and wrote them off as pure gambling.
He basically said Schwab is a wealth management utility, not a digital casino. It was a fascinating defense of traditional fiduciary philosophy.
It was. So here is the question to consider on your own. As competitors lean into these gamified markets, will Schwab's principled, traditionalist stance protect their brand trust with high net worth clients? Or are they leaving billions on the table by ignoring the next generation's favorite way to invest?
It's the ultimate test of brand identity versus modern engagement metrics. Can't wait to see how it plays out.
Same here. We'll be tracking the data closely. Thank you for joining us on this deep dive into Charles Schwab's quarter. Remember to keep your portfolio smart and your ticker talk sharp. Until next time.